performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. Man, time just goes faster as you get older. I used to always think about the type of people used to say time flies, and I just thought time was standing still. Yeah, that's because I was young and didn't have a whole lot of responsibilities. But anyway, so I'm here. I think my laptop is broken, or it's the thing I'm hooked up into that the power source is broken. So I may have to do this one just looking at my magazines that I have. And I always bring a ton of magazines with me everywhere I'm going. And it's always something like Scientific American, or a Kiplinger's Ink magazine. Those are pretty cool. I have a Bloomberg subscription in my office, and that's pretty good. The reason I'm stammering right now is I think my laptop's giving out on me. Oh, here it comes. Wow. That's amazing. It's unbelievable how some things, in this day and age, technology just stops working. I'm thinking about now to my, we have a nice office. You ever want to talk to me about your personal objectives? We recommend that you call, make an appointment, come in. And I'm telling you though, the internet in that area, and these are big office buildings, they're expensive. But the internet service coming in there is unbelievably bad. So I think 1 or 2 days a week over the entire year last year, we had to go, me and Gary and Melissa all had to go back home where we had good internet connections to work from home. And thank goodness, that you can do that. In fact, the only reason that we have an office is for clients. It's not for us because we don't need it. We can do everything we need to do from our homes, and that's pretty cool. But anyway, there's always a lot going on. How's it going to affect markets? Ultimately, markets are going to go higher. And over the years, I've gotten a lot of responses from them. Yeah, but it's not going to go straight up. Well, no, you've never heard me say that. And it's going to go up, but it's going to go down too. It's not a straight line. That hasn't changed at all. It's one of the things that really hasn't changed. The speed's changed. The quickness, the number of stocks that will make new highs and new lows each year has increased as a percentage of the overall stocks that are available. And there's just so many things that affect that as well. But underlying everything, if you don't have a strong economy, you're not going to have strong financial markets. And that's one thing that if I could ever implant into a young investor's mind, is that the economy is going to stay relatively strong because demand grows over time, and demand just grows. It grows for multiple reasons. There's the fact that populations are expanding. They're not expanding nearly as much as they used to. And I'm sorry about this. The computer just does not want to cooperate, and very frustrating. There we go. But anyway, so you've got this demand that's always going to be growing, and whether or not the population grows, new generations want new things. I'm looking around at the technology that I'm using right now, and this stuff's probably 4 or 5 years old. And so the newer stuff can do a whole lot more than this can, but I don't need it. So I don't know, if I ever do need it, I'll just get the new ones. And by the way, I'll be spending less money on that than I did on this. That's one of the things that you also have to probably try to get through your mind. Another thing that if you're younger and you're looking around, hey, what should I do? The financial publications that are out there, the television shows, they're pretty good, but they give a lot of data, and they don't really explain the data very well. They don't have the time, actually. They got to sell more commercials, but they just give you a lot of data, and when you apply it to your own life, then it starts to mean something, hopefully. And you can get lots of really good sources of data. The really good data is expensive. That's another thing that I think is not too cool for the average person, because it takes a long time to figure out whether the data that you're using is reliable or not. And then when you do find the reliable data, there's a cost involved, and it can be fairly steep. So I know we spend an awful lot of money on our stuff just to run a couple different portfolios. And I like those. In fact, we're going to get to those right after we come back from the commercial break. It's going to be 4 or 5 minutes from right now. So I don't want to start it, so I won't have time to finish it. But anyway, we're going to come back to look at some of the ideologies. And that's the one thing that hasn't changed at all since I've been in this business, is that your investing success really depends on how well you are mentally. I mean, it's not 100%, but it's a large percentage. And that's one of an advisor's jobs, is to say, hey, these are the potential outcomes. This is what could happen if we make this investment. Obviously, an investment advisor doesn't make recommendations for products that they believe are going to fail, but not all of them are going to make it. That's just the way it is. And instead of investing directly into one of those investments today, now you have investments that make multiple investments in things like that. I'll give you a good example. Real estate investment trusts. Real estate investment trusts are basically you're investing in real estate. They invest in all kinds of things. It's all over the map, from hospitals to hotels to casinos. It's individual homes. It's all real estate. To be diversified in real estate investment trusts, you'd probably need more than one fund to be able to do that. And it's it's one of the asset classes, one of the categories that is not really talked about that much. People confuse an individual investment. Hey, there's this real estate investment trust. Okay. Is it a singular company that does certain things, or is this a fund that invests in lots of companies that invest in real estate? And, and the reason I'm spending a lot of time on that is that it's just important that you know what you're investing in. And I love using index funds, and I've had several conversations in the past couple of years about people who came to me and said, hey, we want to invest in index funds. Yeah, me too. That's basically most of what I use. And then there's a couple of other individual stock funds that I like to use in addition to that. But they're every single one of these things is governed by rules, like the real estate investment trusts. They're not allowed to invest in technology companies. That's not why they're there. And some of the indexes are. The Russell 3000 is made up of over 90% of all the publicly available securities that you can invest in. It's in that one fund. But it's market cap weighted, which means it puts more money in the bigger ones and less money in the smaller ones. The smaller ones are probably growing a lot faster than the bigger ones. I know they are, actually. So why would you put more money in the bigger ones and avoid those? Well, that's one of the reasons you have advisors. It's one of the reasons that there are so many funds out there, because there's so many ways that you could take a look at that and try to take advantage of it. That it employs a tremendous number of people and creates a lot of information. I'm not so sure that that's all that good, but it is unbelievably better than it was when I started in the industry. And there's a lot to know now. There was a lot to know then. Heck, there were 11,000 publicly traded individual companies on the major exchanges when I started in this industry lifetimes ago. And literally over 11,000. And there's no way you could know each and every one of them. So today, it's a little over 3,000 somewhere. And some of them you wouldn't want to invest in either. And still amazes me that anybody tries to pull one over on investors. It's not if you're going to get caught now, it's when. Okay, and when are you going to get caught, and how much is it going to cost the investors, and how much is it going to cost the people that decided that they thought they were smarter than everybody else and was going to try to pull the wool over their eyes? Some of them actually leave the country and get away with it occasionally, but that's not very often. And it's just another reason to really spread the money out. Today, it's less expensive than it's ever been to be able to use somebody like myself. And the fees that we charge are basically to go through, do that research, look it up. We'll talk to the managers. Hopefully, they've got experience enough to be able to understand what the managers are telling you, because there are extremely good products out there, but they don't all move in the same direction at the same time. Now, and that would defeat the purpose of diversification. If everything moved in the same direction at the same time by the same dollar amounts, why would you diversify? You could just buy any of them. There would be no reason to diversify your portfolio. And thankfully, that's actually not how it works, because I can't imagine that's it's like a science fiction movie that's going to end up bad. But anyway, by the way, I was just looking at there's a ETF that invests in gold. We get people that ask about gold a lot. There's gold in a lot of the indexes that we use and some of the funds that we use. So I don't really follow gold itself by a lot, because it's already in the products that I'm using now, and they're managing it. So I don't have to keep my eye on it, because they are. And that's a good idea. I think that's a great way to invest in it. If you did want to buy gold, I would say just buy it yourself. Get a safe deposit box. There's no guaranteed way to keep this safe, by the way. Because you put it in a safe deposit box and it goes and it disappears. How do you prove you ever had it? I'm sure today there's some sort of method, but back in the days of old, where they didn't even look at what was in the security deposit box. That was one of the reasons people got them, so they could put documents and stuff and holdings in there that nobody saw. So if it's these little tiny gold bars, and the reason I'm talking about this is I had to help some clients years ago go open safety deposit because they wanted physical gold. They thought that, hey, if the world comes to an end, I'm going down to the bank and I'm pulling that gold out. And I'm like, okay, my job is not to make you do what I think is best for you. My job is to try to help you, even if I don't really agree with it. And something like that probably is not going to hurt you too badly. And the way that gold's performed since then, it's actually been pretty good. But if you look at the return on gold from the late 70s, when it was really running, mid to late 70s, to where it is today, a money market fund has done better. So anyway, I've only got a few seconds here before I have to take a real quick commercial break, so I'm just going to plug my firm again. This is Bill Bullington with Bullington Capital. You can go to my website, bullingtoncapital.com. If you'd like to call us, if you'd like to talk about your investing situation, then it's not going to be a problem. Anyway, I got to take a real quick commercial break, so I'll be back after these messages.
There's torn up pages in this book, words that tell me I'm no good, chapters that define.
And welcome back. It's a Bullington Capital Report. My name is Bill Bullington. You can go to my website, bullingtoncapital.com, if you have questions for me. If you want me to look over your stuff, that's another thing I was thinking about this morning. A long time ago, when I first got in the industry, I sat down, I spent an enormous amount of money, especially for a kid. I think it was in my mid-20s. And I spent a lot of money on this software that would let you run simulations. We call them hypothetical illustrations, or hypos for short. And because I really wanted to know, what the stock market really was all about. And man, I learned some stuff that they were not teaching us at the companies that I was working for, because there were several over a 10-year time period. But I think there was 3. And it was crazy. I'm thinking, I go to my manager and I go, hey, did you know that this, back in the 1970s, if you'd invested in 1969, by 1982, your money would have been exactly the same place it was? You'd have made nothing. And he didn't know. Dude did not know, and he's supervising. He's supervising advisors out there. It's just, it's mind-boggling, the lack of access to information that this industry had. And today it's it's nothing. I mean, all you really need is a computer with an internet connection, and you need a lot of time, because it's not going to be easy. That part, there's still a huge volume of information that you really need to know before you start to get it. And what's going to happen is it's going to destroy that confidence you had before you knew better. That's just life. You learn by trial and error, and hopefully you try to study before you get involved. And the more work you do, the better off you are. But there's more access to an awful lot of information. But quite frankly, that information was out there. I mean, I used to go to the Parma Library and think about that for a second, because they had more than the Cleveland Library did. Cleveland Library had more in certain areas, but Parma had some really nice subscriptions to information, institutional investment information. So I would take off, on a Monday when it was really slow, go in at night and do a whole bunch of research there at the Parma Library. And why did I do that? Everybody else that I was around, they sold product. Okay, just products. Just learn this and you'll be fine. You don't need to know all that other stuff. Yeah, but I want to. So I hate investing in something that I don't understand. That is That's how people get taken advantage of. That's how things go wrong. Okay, so we want to avoid that as much as possible. Thankfully, it is way easier today to do that. And there are some really good programs out there. And, the industry that's just ETF. Sorry about that. My computer interrupted me. There are lots of products that that have an awful lot of education inside of their websites, and I'll tell you, very, very helpful. Now, if you don't have a lot of time, this is probably the number one mistake I see in younger people. I guess I was born old. We didn't make a lot of money. My dad was self-employed. He worked super, super hard, and was a lot of things going on there, but he just didn't make a tremendous amount of money. So it was he was not going to have the amount of time it would take to do the investing. In fact, when I got in this industry, my mom, rightly so, just told my dad to shut up. It's like, and she wasn't even as kind as that was. But it worked out well for him because they did very well. He was able to retire, and he was a non-union carpenter. He had gone to 12th grade. They moved from Tennessee to Detroit, Michigan, and Detroit, Michigan wanted to set him back into the 10th grade. I think they were biased against hillbillies, actually. They wanted to put him back in the 10th grade. And he said, no, I'm not doing that. And he was going to a school that actually was a vocational school. And he wanted to wanted to be an architect and draft, he was going to go to an architectural college. And they set him back so far and said, look, he can't. If you don't go back to the 10th grade, then you're expelled from school. So he said, okay, I'm leaving. And he just started working. Never went back. And anyway, bottom line is I look at what kind of tools that they had back then. And I'm comparing them to the tools that I had when I first started in this industry and where they are today. I mean, it is mind-boggling. How much more information you have access to and how quickly you can get access to that information. But information is not knowledge. They are not the same thing. Information is not experience. And oftentimes you don't realize what the risks are that you're taking. And you get a guy like, I would probably be retired a long time ago, actually, had I just told people what they wanted to hear, put them in a program that, paid the most to me, and then just let it fly. And quite frankly, the clients probably would have made more money. The problem is, in order to make that money, you've got to be there. And when you get these big drops, the ones that have the highest returns also have the highest fluctuation. So it's a balancing act. And everybody's got a different attitude towards that, and everybody has a lot of different education as far as that goes. How much experience do you really have at this? I know some kids, I call them kids. They're in their late 20s, early 30s. That's a kid now. They're extremely knowledgeable on investing tactics. Fortunately for them, there are only a little over 3,000 companies, not 11,000, that are publicly traded in America, because that would make it a lot different. But yeah, if you've got the time, you want to put in the time, the effort, the energy, and the energy is psychological. As you start to get older, I'm telling you right now, that psychological energy, it starts draining very quickly. And you can only take so much at any one time anymore. So you have to kind of space out your days. Look at, I'm going to do my most stressful, hardest stuff early in the day. so that I can kind of kick back later in the day. If you're able to do that, a lot of times it's going to be hard all day. But then you have a lot of days where it's easy too. So anyway, it's all psychology. As is all psychology. I shouldn't say that. It's mostly psychology. It's probably 10% knowledge, which incidentally, that 10% is necessary. You got to be 100% on both your knowledge, the knowledge that you have, and the psychological part of it, if you're going to be in that top 10% group. And I think it's a lot easier when you can find someone that'll go out and do that work and bring it back and let you know, match you. The most important thing is getting your risk type correct. And I have this super simple. This is not something new. I've been doing this my entire career. I had a super simple questionnaire that I had put together myself when I started my company. I was so frustrated with every financial firm that you worked with making questionnaires, and they still do this crap. A lot of them do. They make a questionnaire that's so complicated, clients don't have any idea what they're answering. They don't know. They don't know what it means because it can mean a whole lot of different things. Words have multiple meanings. And a lot of the financial industry participants, they take advantage of that. Well, that's not what we meant. Well, that's what I was told. Well, it's, there's actually more than one meaning. Well, so anyway, that's not as common as it used to be, incidentally. I think that's another thing that really has improved the industry that I'm in, financial services. It's a lot more truthful than it was when I started. When I started in the business, I keep aging myself, but you really had to trust somebody. And in fact, a lot of stuff came out so quickly that we were trusting our firms. We were trusting the analysts to do their homework and to be honest with us. And sometimes that didn't work out so well. Quite honestly, another reason that diversification is important. But again, stuff like that's not nearly as common today. So that's one thing that I think is good for the investor. Most of the stuff that you have access to, the information tends to be pretty good on it. Whether or not somebody told you how volatile things are, and that's really the one area where I think that there needs to be more work done. I was talking about this stuff for forever now. They're starting to do it. The big influencers in our industry are starting to come forward and starting to show a lot of the data that I've been talking about for my entire career. As soon as I learned about it, I think it was like 1987. I went back to these guys, these older guys in my office, and I said, "Hey, is this true?" And Peter Lynch said the average stock on the New York Stock Exchange has a 50% annual range. It could be up or down 50. In fact, that was the average range per year of a stock on the New York Stock Exchange. Is that true? And the guys that were practicing said, "Yeah, that sounds about right." And because they never really had to test it, they just lived it. And but the managers were like, "Oh no, that's never that. That'll never." They were afraid you wouldn't be able to sell anything, and so their idea was just go into it not knowing. And okay, all right. And a lot of people were very successful that way because they would sell a whole lot of stuff, and then when the markets did crash, they would go back. They're talking to their clients and saying, "Well, everybody." Oh. Yeah, but, and incidentally, if everybody knew what was going to happen, the most popular investments in the world would have been balanced funds, and where people would have not made nearly as many mistakes because it gets really emotional. That's one of the reasons, a few years ago, I've been looking at the returns on annuities. When you see the net return on annuities, you're going to have to do extremely well in the stock market to keep up with that. And I had, when I first started doing it, I still get people say, I don't want to hear about annuities. Yeah, okay, bury your head back in the sand, and come back in 5 minutes when I stop talking about it. Because it's important. And these guys are sophisticated. I mean, insurance companies, back in the day, when I first got in the business, man, they ruled. They ran a ton of pension funds. Why did they give it to an insurance company? Well, because there are these, an annuity was actually, it's the first pensions. They're all annuities. And a lot of them are still pensions, annuity products. And they used to call them private pensions. They've come up with all kinds of regulations now to prevent that sort of thing because, some of the insurance board said that's misleading. And I understand. I really do. I've only got about 60 seconds here before I got to take a commercial break. If you'd like to call in, the number is 216-901-0945, 216-901-0945. We'll spend the last 15 minutes or so talking about future products, future companies, lifestyles of the future, which are going to basically be the fire under the stock market. It's kind of what makes it go higher. Anyway, this is Bill Bullington right here on 1420. I'll be back after these messages.
A choice is set before you now, living or dying, blessing or cursing.
Welcome back. This is Bill Bullington. I'm here every Saturday morning from 11 to noon, right here on 1420. If you'd like to get in touch with me, go to my website, bullingtoncapital.com, or you can call us at 330-664-0700. And, this is basically the same tone of voice I use all the time. And so I want you guys to do whatever's best for you, bottom line. And oftentimes, this is where it can get pretty difficult. When you're making these decisions, they're very important because they're going to have a big impact on the rest of your life. It's not that you can't change your mind, but you don't want to be changing your mind when the market's down 30%. That's not good. If you didn't know that potential existed, and now you do. And that's just really, really rough. It's a tough way to find out, and that's not how you want to do it. You know what? One of the good things, too, about today's 60-plus category, even the 50-plus, and even the younger people, they do have a lot more information. They have a lot of access to information, so they can look up and do a lot of fact-checking, which I think is a great thing. Once you get really good at this, you're going to realize that, it's a vocation. And do you really want to spend, that's like, some people do their own taxes, hats off to them. I can't imagine trying to do my own taxes, especially as complicated as mine are. But so it's just, when you come in or you talk on the phone, this is it. This is how I'm going to sound. Okay? And I want you to do what's in your best interest. And sometimes people, they do the wrong things, okay, but they're comfortable with it. So there's a really good chance that somebody they may not be as successful as they could have been, but if they go the route that makes them uncomfortable, even though that's the right route, okay, because they're uncomfortable, they make bad decisions and bad moves at the wrong times. They give up, and that's a tragedy. They probably should have taken the other decision. Probably would have made less money. But would have kept them comfortable and would have prevented that big mistake. And that's really hard to do, and it's one of the reasons that you've got a whole bunch of computers out there that can put portfolios together. I use them all the time. Okay. And, but it's not going to be able to gauge, what's important to you. How badly do you really want to see your kids get that college education? It's probably not a good idea to wait until they're in the 10th grade to start saving for it, and then to put down a pretty big chunk of money into a stock fund. Why? Stocks do better than, yeah. Well, they have done better over very long time periods, and there are some fairly long time periods where they've done really horribly. I've lived through it. So that's one of the reasons that the balanced funds have a place in this world. People that really need to put 100% of their money in stocks are younger people who maybe they're not making a whole lot right now. And you say, well, they shouldn't be putting in stocks. No, if it's their retirement money, and it's in their IRA or 401k at work, yeah, you should be investing in stocks. If you're putting that money in there thinking that that's your emergency money, well, your thinking is wrong. Your emergency money, yes, that should be put in short-term CDs or treasuries or money market accounts. But it's for emergencies. If this is longer-term investment money and you're young, you need to be in stocks. And there are certain algorithms out there, the ETFs. I just laugh when I start thinking about some of the conversations I've had over the years. People, they think it's easier if everything is the same. Okay, and that's very, very dangerous thinking. But it's easier, and so they'll take multiple items and put them in one category, and then you go start looking at it because it makes it easier for them if they can think of it that way. But when that way conflicts with reality, you got a problem. That's a problem. And I just think it's funny. It's so easy, and it's not I don't know. But that's after doing it for all these years and talking to so many people through all these years. And as you get older, these younger people, the public in general has a pretty bad point of view when it comes to annuities. Overall, and I get it. They've been abused. There are a lot of products out there, and there are a lot of people that are selling it that quite frankly, to get an insurance license is not nearly as difficult as securities licenses are. And so if you've, there are an awful lot of people out there that have licenses to sell products. I'm pretty sure a ton of them don't understand exactly how they work. I know they don't. I've been in this industry for over 30 years. And a lot of them just don't want to put the time in, or they just want to tell you what you want, what you want to hear, and get the signature. That's not how I work. I never have. And it's cost me a lot of money. I guess it would have been a lot easier just to tell them what you want to hear. And then and by the way, you potential or even actual clients out there, the opposite happens. You guys never get called out for this. You keep bending and twisting your demands for your advisors to what kind of products that you will invest in, just to try to manipulate them into giving you what you want. And a lot of salespeople don't have the guts to call you out on that. Well, that ain't me. I will call you out in a heartbeat. And when you want something that doesn't exist, okay, and that's the only thing you're going to buy, well, obviously some salesperson's going to, it's sooner or later, you ask enough salespeople, somebody's going to figure out, hey, this is what they want, and they'll buy that. So yeah, I'll just, whatever, I'll just tell them what they want to hear and give it to them. That's what I'll do. So it's tough, man. That's probably the hardest part of the whole industry, is finding somebody that you can really trust. And if I don't know the answer, that's what you're going to hear. I don't know the answer. It happens all the time. That's why 30 years of experience is very helpful. I've had to go look stuff up, and I've learned 3 times as much information about how things work by doing that than I have, studying any of the courses that are available. And so that experience is very valuable. And by the way, it's always changing. The stuff out there is always changing. And so when you have questions, that's one of our jobs. Look it up. We'll go back and we will look it up. And sometimes people get upset that we don't know the answer right off the top of our head. Did you ever see the Internal Revenue Code? It's only a little over 10,000 pages. Small print, single spaced. It's a lot. So things are changing fairly rapidly, and it's one of the reasons that we still have jobs. Oftentimes people are worrying about, heck, I've done that before. I've misunderstood and was about to go make a decision on something and would have been a bad one. That's happened probably at least 10 times over the last 30 years. And thank goodness that I'm also like a lot of clients. I don't believe if I can't verify something 3 times, and I just figure that I'm not going to make a decision on that because I don't have enough information to make a good decision. And hopefully that's where people like us can help. We can show you and show you how the bigger firms are doing it. And after all this time, I think it's hilarious to me. It's just not that difficult, but it is difficult when emotions are high. And retirement planning, is emotionally triggering, big time. There are a lot of fears. Everybody's got the fear of running out of money. That's a good one, and I would rather you have that fear than the opposite. The fear of no fear of taking risk, because at some point in time, old man time bats 1,000. You start slowing down, and sometimes you're not going to have the time to make back that money. That it's going to fluctuate. By the way, I'm a firm believer that markets will be higher over the next 10 years than they are now. And I know a lot of, I could just see other people rolling their eyes. Well, 10 years, you're not telling me anything. No, I am. I'm telling you a lot. Okay, you just don't realize it. You don't understand. You want to know what the market's going to do yet next year. So does every other con artist on Wall Street, and they're willing to tell you that. Whatever you want to hear, they'll tell you. Okay, so anyway, I shouldn't spend that much time talking about that. It's hard. How do you know that the advice that you're getting is not good advice? How do you know that somebody's not just trying to give you this advice to make sales on certain products? And it's a really hard job, and I do not envy the public for that, because it is a lot of work. And again, finding somebody that you think you can trust is kind of key there, and goes with whole tons of things. It's not just the personal finance, but buying a car. I guess that kind of involves personal finance, but anyway, there's a lot of stuff out there. It's always changing. There are strategies out there, and that's actually what I was going to spend more time today speaking about. And when people look at the S&P 500, that's the most popular index in the world, actually. And they can't tell you how they pick the stocks in there. They don't really know. All they know is, the performance. Well, if that's all you know, buckle up, okay? Because that is extremely volatile. Not a little bit, okay? A lot. It is going to test everything you have in you. That's why. Do I have that? Yeah, it's actually I got the institutional versions in a couple of my accounts. So I'm not saying it's bad. I'm saying it's not what you might think it is. And again, people want things too simple, too easy, and they don't want to do the work. Some people do an awful lot of the work, but the work comes in with a bias. They already have an idea of how things should work, and they only pay attention to the information that agrees with that. I know, and I'm saying that, and if you're a married couple and you both happen to hear this, or if you're just married and you're listening to this show, you're like, oh yeah, I remember. Because that's typically what happens with an awful lot of arguments. But hey, I've only got about 60 seconds here left before I got to go. This is Bill Bullington. I'm here every Saturday morning from 11 to noon. If I can help you, I will. In order to know if I can help you, then you guys got to go to Bullington Capital and reach out to us. You can send us through email, bill@bullingtoncapital.com if you'd like, or call us 330-664-0700. And I appreciate you listening again this morning. And everybody have a good week, good investing, and good luck.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.